Good morning. It is Dan Kerr's DK Analytics. I'm chiming back in with a video. It is Monday, March 2nd, 2020. The title of my video is the Coronavirus Accelerator, the straw that threatens to break the globally floundering economy's back. Before I get into the topic, some valuation metrics. Trade weighted US dollar stood at 117.1. The US 10-year yield was at a record low 1.1%. These are based on Friday's closing prices, by the way, February 28th, 2020's closing prices. The S&P 500 stood at 29.54. Oil has been under large pressure, has declined by Friday to $45.43 per blue barrel. Gold closed out under pressure, as did silver on Friday at $15.97. That is $1,597 per troy ounce, and silver at $16.66 per troy ounce. The old broad-based U.S. index has been discontinued, which has forced me to switch to a different one. I apologize for the discontinuity, but the dollar remains in modest rally mode, but is still below last year's high. So a dampened flight to the U.S. dollar safety going on here, which is to be expected, at least by me, as you well know. Meanwhile, the rally into so-called safe haven government bonds has pushed the 10-year Treasury into unprecedented record high valuation, concretely once again a 1.1% yield, which is giving us Wall Street's dreaded yield inversion. More on that later. In the interim, the S&P 500 is 12% below its all-time high just a week ago. In other words, it peeled off these 12% within a week. And early Monday prices are largely unchanged from Friday's February 28th closing price. Separately, oil's price has been crumbling with economic contraction fears. Finally, precious metals prices got whacked late last week on Friday in particular, as the global stock market rout gathered momentum, just as initially happened in the 2008 equity market swoon prior to a massive precious metals rally soon thereafter in 2009, as gold and silver resumed their traditional flight to safety asset status. I expect that to be replayed and more this time around. That's the takeaway. Now, on to my topic, the coronavirus accelerator. In the U.S., so just for some background here on viruses and the impacts and the deaths, unfortunate deaths that go with them. In the U.S., roughly 56,000 people succumb to the flu or viruses of one sort or another per year. So far, there have been 2 U.S. deaths associated with the coronavirus and 3,000 global deaths. In China, the spread of the virus is slowing drastically, even as the economic impact of both the lockdowns and the contagion fears, in other words, the behavioral impact, have conspired to crush economic activity. Some cases in point here, courtesy of the China National Bureau of Statistics, as provided or showed by an outfit called Wolf Street. Here we go. I'll bring this onto the camera. Talk about a picture being worth 1,000 words. Here is the PMI, which is the Purchasing Managers Index, Chinese manufacturing. That is, purchasing managers get asked in anonymous terms about how orders are trending, backlogs are trending, how payroll is trending, stuff like that. And then they're put together to be a pretty good predictor of near-term economic trends. And what we can see here is this PMI index just falling off the cliff, straight down. Pretty powerful statement about how the manufacturing engine of the world is faring under this, which is obviously not a precursor to solid global growth. I think it's fair to say that we are all well aware of how the factory of the world, China, is critical in terms of finished goods manufacturing. Think Apple iPhones, or electrical equipment, or machinery of all sorts, or think about your Walmart or Home Depot shelves, or think in terms of parts manufacturing. From vehicle parts, I know when I get parts for my older cars, they're almost all made in China, to computer parts to integrated circuits. We, I think it's fair to say, are also all collectively aware of how decades of just-in-time inventory practices in order to boost asset turnover, that is, holding less inventory while still selling as much or more, how this helps to increase ROI and ROE, because one of the main pillars of return determination, asset turnovers, improves, right? But this same practice, along with us, has also made corporations more susceptible to supply disruptions, especially with global sourcing. If we combine the two, Chinese dependency, a global supply chain, and thin inventory levels, then what we see is industrial / manufacturing output in the process of being slammed, meaning sales or economic activity that would have otherwise taken place are going to take a hit. Think of that PMI chart, the manufacturing chart here, from the source that I just told you, from China and Wall Street itself. Again, I'm referring to this, and that is so significant given China's manufacturing dominance. Talk about the downside of globalization and asset turnover maximization. Call it a supply chain nightmare unfolding before our very eyes. Perhaps the only slight domestic U.S. procurement savings grace, still higher than normal inventory levels on the back of ramping up stocks inventory thanks to Trump's tariff imposition on Chinese imports. Sometimes stupidity, or even more cronyism in bureaucracy, ironically turns into a good thing. Call it the law of unintended consequences. Let me see if I can highlight exactly what I'm referring to. This buffer of inventory, thanks to this trade war ridiculousness. Here we go. All right, this is from the Federal Reserve Board. And what you see here is after Trump's election in early 17, we've got this massive ramp up in U.S. inventory despite relatively flat GDP and sales, okay? There's about 300 billion or 400 billion more from here to here. So this is, in this case, an appreciated buffer, but even that has limits. Okay, let me continue. Now, if we add in the fact that lockdowns of one sort or another threaten to spread or are spreading from China elsewhere, things start to take on an even more powerful economic contraction level. Case in point, last week, Japan sent their public school kids home through April because of the coronavirus. Throughout the OECD world, politicians consider Trump's arguably sensible Chinese travel ban, but politicians are getting antsy to take a page out of China's or Japan's book for CYA reasons, if nothing else. Um, this will compound the negative impact on global economic activity. How so? As an example, consider demand for transportation and hospitality services, two major industries virtually around the globe. Demand here is getting slammed as emptier jetliners and emptier hotels show. Let's take another look at China for a stark preview of what threatens to spread elsewhere, at least to a degree, in the non-manufacturing or service sector of the economy, which is the dominant sector in virtually every economy. Let me see if I can get this onto the camera here. All right, same source, Chinese government statistics and Wolf Street. Here we've got the official non-manufacturing PMI. And again, the PMI Purchasing Manager Index, and these are the managers that have the pulse of what's going on, in this case, in the service sector. And here too, just like in the manufacturing, it is plummeting, probably without precedent, at least as far as modern day China is concerned. Now, it doesn't end there. Let's layer this muffling of economic activity on top of unparalleled global debt, that is, the muffling created by the behavioral or the response to the coronavirus. Let's layer it on top of unparalleled global debt requiring stout cash flow, increasingly stout cash flow, to service for both corporate entities and for households' debt obligations, for widening public sector deficits owing to less economic activity, lower taxes, prior to more pronounced global weakness, for widespread financial repression-induced misallocations and malinvestments and the related declining productivity growth, and you have a recipe for a perfect economic and financial storm in which financially engineered corporate profits stand to be compressed, not just to a garden variety 40 to 50% contraction, at least in the US, but well beyond that, such as in 08-09 in the US, a period during which the S&P 500 GAAP EPS ended up plummeting by nearly 82% before finally bottoming out. With an S&P 500, despite the recent whopping 1 week 12% decline in that index, still trading for 21 times trailing 12-month GAAP EPS, even as poor quality EPS are likely peaking prior to sharply weakening economies, which the coronavirus manifestation has only exacerbated, one could argue that there is still substantial value at risk for those invested in U.S. stocks. A side note, you may recall that in my Valentine's Day video, just a bit more than 2 weeks ago, I noted that given all the algos, momentum trading, widespread ETF copycat allocations, and the huge derivatives exposure / risk, that a market decline, a stock market decline, could come swiftly and powerfully. This has indeed happened. Let me now go over a few more numbers to highlight value at risk in the stock market. If S&P 500 EPS were cut in half, that would make for a 42 PE at today's S&P 500 level. If S&P 500 EPS were cut by 75% and the current valuation was maintained, it would make for a PE of 85 based on Friday's S&P 500 closing valuation, the closing quote, which is nearly unchanged so far this Monday morning on March 2nd, 2020. Furthermore, note that it took 5 long years to regain the prior high water mark EPS of 2006 last time around. Took till 2011. Also note that the EPS compression happened in the wake of the barely contained financial crisis of 08-09, in which S&P 500 EPS collapsed by 77.5% in 1 year and by 81.7% from peak to trough. Given that we have much worse fundamentals today than we did in 08, we could easily face a comparably long EPS recovery road ahead, if not a substantially worse or longer one, making the current S&P 500 stock market valuation, the index level, and the associated value at risk even more indefensible given the huge downside risk. In short, not in the sustainability valuation cards, a blue chip index, the S&P 500, with a PE of 21 times peak earnings, that could be a quarter the EPS of today's level in relatively short order and then stay down for the count. This would be true even with zero bound interest rates, as ZIRP and NIRP policies in other OECD countries have shown, as concerns their stock valuations, which always take their cue from interest rates. Moreover, and as mentioned many times, at some point people will lose, investors will lose faith in counterfeit currencies, in fiat currencies, meaning that, by extension, they will also lose confidence in their investment manifestation, especially de facto government junk bonds in mega bubbles and, to a large degree, in overvalued stocks offering little real asset inflation protection. In the interim, as in perhaps as of this week, oversold, battered global stocks are due for a technical rebound. This rebound will likely be strengthened by one major central banker after another committing to even greater money printing or interest rate decreases where still possible, such as in the US, where Fed head Powell already telegraphed to Wall Street crybabies that the Fed will stand ready to stem an outsized stock market decline. Of course, the J-man didn't say it like that. He stands ready to support a vibrant economy. These people know no shame. Either that or they're just plumb stupid. Worse, by printing even more money amidst a global supply shock, this will only fuel goods inflation, even as no one is going to get into an airplane or book a room in Sydney, Australia, just because the Fed lowered its interest rate by another 25 or 50 basis points. Or even if they did it 3 times in a row, which apparently is the new consensus. So much for the Fed standing pat on the interest rate front. How soon until the new QE round is kicked into even higher gear? How soon until the Fed's hedge fund repo rescue also gets started back up, if not expanded, as money center banks increasingly distrust their own brethren's, each other's liquidity and balance sheets, yet continue to rely on artificially low short-term financing courtesy of Fed intervention or courtesy of the Fed's discount window funds availability, which Kingpin JP Morgan just tapped to signal that doing so wasn't a sign of bankruptcy. Without de facto bailouts by the Fed, the Wall Street cronies that own the Fed would otherwise risk either short-term financing drying up or their cost of funding outstripping their hugely leveraged 50 to 1, 100 to 1 invested portfolio yield bets, all right, which happened briefly last September when the repo spiked to 10% to reflect these concerns, which then triggered the Fed's huge repo QE response to effectively bail Wall Street out of potentially destabilizing developments, including their huge asset liability mismatches and their subsidized short-term funding, which stands in contrast to their longer-term commitments or their portfolio. This cronyism and the associated Fed interventions will continue in the United States of Goldman Sachs and elsewhere. And it may well provide investors with another opportunity to part with bubble valuation stocks purchased at the dear prices of the past few years. I would say that such a market bounce will provide investors with another opportunity to lighten up on overvalued stocks purchased at elevated levels. In the interim, investors should also look to reduce exposure to massively overvalued investment-grade bonds that, which really aren't in most cases, that feature no real yields, but instead expose investors to huge capital and purchasing power losses and being damned in low interest rate land, all right, given the inevitable stagflation that sustained financial repression, which I'm convinced will now be doubled down on to untold levels, inevitably results in. I hope this helps frame your investable portfolio thoughts, your investable portfolio allocation thoughts. And while you do so, please don't forget what would happen to elevated PEs around the world if a deepening recession, massive layoffs, and collapsing stock markets extend into the fall of this year. In a related manner, think of what communist Bernie Sanders as president would mean for what remains of property right protections for PEs. Yet, this isn't on anybody's radar, even though presidents are elected virtually solely on how fat or thin your wallet is on election day and whether or not you have a job for those still in the labor force. In closing, I will devote the next video to self-serving, C-suite induced corporate anorexia and to the de facto LBOing of the Standard & Poor's 500 and how these twin delights have heightened solvency risks while castrating economic growth potential and thus future organic growth. Over and out. This is Dan Kurz of DK Analytics. It is March 2nd, 2020. Bye-bye.